For Tuesday the 18th of July. Let's have a quick recap of some of the main events for the session, and let's start off with the pound. So I know a lot of you guys have been trading throughout the day, so this is very much just a recap of things, but for those who may have not sat in through the whole session, the pound, one of the best moves we've seen thus far. Out of all the different instruments, certainly there's been quite a lot of movement today, but starting with specifically the cable pair, we had a bit of a run-up actually going into 9:30 before the key release of inflation data. This was a break then of what was the weekly high, and if you put it on a daily continuation chart, you'd have to go all the way back really till several months since pre-US election. We're looking at September really of 2016, the last time we were trading up at around these levels. But just going back into how the price action unfolded, a little bit of pre-market movement may have led some to believe that potentially we could have been in for a firmer CPI number, but then as we got into the 20 minutes or so before the release, we already saw a pretty quick about turn back through then the initial R1, also through the kind of late Asia Pac support level, all the way back down to pivot. And this specifically tends to happen with UK economic data, whereby there's often a propensity for historically the data to be leaked, and you tend to get a bit of pre-release movement that can often be quite telling of then the direction of the data coming in. This then would have been indicative of a weak number potentially getting circulated. As we came all the way back down to pivot, then the number came out and we were expecting a 2.9% year-on-year reading for UK CPI, and this is what we got, 2.6%, obviously way down on expectations. And for, I would say, for a CPI print, a miss of that proportion is statistically very large. I know it doesn't sound that large, 2.6 from 2.9, but very rarely do you see it kind of move in that size increment. It was the lowest inflation rate in 3 months, as prices rose at a slower pace for motor fuels and certain recreational and cultural goods and services, according to the Office of National Statistics. What did that lead to in terms of price activity? Well, we immediately shot lower again, renewed weakness. We hesitated momentarily at around the lows that were seen yesterday afternoon, before then pushing down to R1, or excuse me, S1, of which point then was pretty much a full point move from the morning's highs down to where we were. Now, obviously this has connotations for read across for monetary policy from the Bank of England. We've been sitting on this potentially moving more hawkish MPC split with a 5-3 vote. 5 wanting to hold, but 3, Forbes, McCafferty and Saunders, all wanting to immediately hike rates by 25 basis points in June. That obviously is going to be a very difficult argument to maintain now that inflation, which they were fearful of busting through 3%, has fallen all the way back down to 2.6. And with the economy expected to slow down, now if some of this weakening of sterling post-immediate sharp drop post-EU referendum last summer starts to fade away, the economic slowdown in general should start to see some of that demand side fizzle out, which technically then would say difficult to see inflation then starting to punch much higher. So that led to a little bit of weakness then down towards S2 before a bit of a bounce and settling really around S1 in the cable pair overall. I guess this has been somewhat outweighed, I guess just a case of timing, by a weaker dollar, because the bigger overall theme today has been, aside from the CPI economic data reaction, the bigger macro theme has been the failure, once again, of the latest version of the healthcare bill in the US getting voted out by 2 Republican senators last night. So once again, they brought forward a renewed version of that reform bill, and again it's got rejected. This continues to fuel further belief that potentially it's just going to delay even further, if at all, any of the more market sensitive fiscal policies will ever get implemented, full stop, from Trump. And obviously this was would be a negative in terms of prospects for the US economy going forward. So what we've had then is weakening really overnight. Asia Pac equities are weak. Europe was weak. You can see here centre left on my DAX chart. It's been weakening, steadied out the last couple of hours, but generally finishing the cash close on the back foot. US equities have seen a pretty decent sell-off through the open a few hours ago. You can see here we broke the bottom end of the fairly range-bound session from yesterday, which was around that 24.54 level, the break of that. And then in a Dow, it's probably even more evident, where we saw initial push down to 21,500. We then broke the Friday and consequently Thursday technical lows, and then you can see that really strong wick. No new news. Again, it was almost just a build-up of negative sentiment, and then further triggered by a break of some key technical levels on the downside, causing probably algos to jump on that move from a momentum perspective, and hence you get this really outlying kind of wick on that candlestick for that particular time frame. We've steadied since then, but obviously still down about 100 points or so in the Dow on the day. But everything's kind of not so much being data driven, I would say, from a US perspective, although there has been some data points. The NAHB housing market index, granted, was a little bit softer than expected. The US import-export prices really did nothing to phase markets too much. This is more of a broader disappointment on Trump failing once again on a key reform bill. Obviously, equities weaker. That supported US fixed income futures. T-notes managing to get their head above the high print that was seen at the end of last week. And obviously, that was a really big spike that we had on the back of soft inflation data from the US and weak retail sales report. We're trading above that and the 126 handle. Once again, this just further fuels then market sentiment about the Fed's ability to deliver on their mandate of one more rate hike before the end of the year, and the commencing of tightening of the balance sheet process, which most are anticipating around September as a time frame. But weak inflationary conditions, a poor performance on the US high street and consumer sentiment in that regard, and now further inability of Trump to push through stimulative reform bills, or the expectation of him to deliver on that, is probably going to lessen the confidence of the Fed in order to execute on that more hawkish plan that they may have. And so T-notes rising. The risk-off trade then has seen the Japanese yen strengthen, so dollar yen down on the day towards 111.50. Gold higher on the session, still up around $8 within sight of the... We're still trading up at around the highs of the day, really, since we saw the initial move once we got into the swing of the US session, because that failure on the repeal of Obamacare, that happened pretty late US hours. It was around 1:40 AM London time, so it really took until the US came in today for them to react and for us to see this second phase of the move from what we're seeing in the Asia Pac trading hours. The one thing this is leading to from a major currency divergence, and certainly from a policy perspective, is the euro dollar. So the dollar index down about 0.6% for the reasons I just mentioned. And this flies in the face of what we're looking for is potentially hawkish notes struck by Mario Draghi later this week in the ECB press conference, where he could be laying the ground for the potential moves towards opening the door to a September discussion on QE, albeit likely without any pre-commitment. But nonetheless, you've got an expectation that the ECB are getting more closer towards unwinding some of their loose monetary policy, and now you've got people's sentiment moving away from the Fed being able to be so hawkish. So a bit of a convergence, euro stronger on the day, and so we've got a real key level here on the upside. This is a daily continuation chart, 116.30 and a half. That was the kind kind of late April, early May high, but that was the high of 2016. We're just about to test. We're just short of that in today's session. Above there, the 2015 high resides just above the 117 handle as well. So certainly can't rule those levels out if we were to hear of a fairly hawkish press conference from Mario Draghi this week. Something definitely to be on the lookout for in the next few sessions. Okay, having a look then at the calendar for this evening, just briefly to remind you, you do have the API crude oil inventories. They'll be coming out the regular time at 9:30. Again, you're usually best placed to be looking at Twitter in order to capture that data quickly. But looking at oil prices today, that's also been very interesting and quite seesaw in its direction. There's been obviously a few different headlines. We initially rose. We were already rising quite quickly without much news. I was looking at, in the strategy today, the short at 47, just around the highs that were seen kind of on Monday, giving it some room with a stop around 47.20 and managed to hit the first target. But I know Rabia, you took that, so very well done. I was going to say that I could understand quite fully if you're a bit nervous at the time of placing that short, given that around the top of this move and this extension that we can see on that wick on the upside when we saw the initial intraday high at 47.14, that came when Saudi Arabia was said, so sources were suggesting the country is considering a further 1 million barrel per day export cut in order to offset the rise in Libyan and Nigerian oil production, according to a source. And so prices spiked up. And then you also had at the same time Nigerian pipeline said there was one of their terminals being damaged by sabotage. This is one of the reasons why Nigeria have had the capacity to be able to bring so much oil back online the last few months, is because of these type of civil unrest in their country. So we shot higher, but then we started to see that play out when prices soon started to come under some pressure. There wasn't really any new information that came out, but my overall idea with the short was that compliance levels at OPEC, as we discussed in a briefing this morning, are falling. I think that it's going to be very difficult for them to continue to remain 100% compliant, and we've dropped below that threshold for the first time in 4 months overnight. And US output situation, I don't really see changing anytime soon, i.e. it being quite elevated in terms of US output, currently tracking at its best levels of the year at the moment. So yeah, that was the oil story. The API is obviously coming out tonight, will be influential then for the market's expectations, planning around the Department of Energy numbers, which will come tomorrow afternoon, regular time at 3:30. Tomorrow morning, and actually the overnight schedule in terms of set calendar events is very quiet. Nothing really too instrumental coming out overnight or in the European morning. Not until the US hours we start getting the housing starts and building permit data, and then we'll be looking out for the oil inventory numbers in the afternoon. Okay guys, that's your wrap for today. So coming up to 5 o'clock, I'm going to wish you a pleasant evening. I'll be back on the mic to deliver the briefing as per usual tomorrow morning. So if you're sticking around for the rest of the session, good luck. Otherwise, I'll catch you guys again in the morning. Thank you very much.